Well, the dollar and yields on the move today after President Trump called the greenback overvalued and said he'd like to keep interest rates low. That's actually a far cry from the comments he made on the campaign trail, for those of you keeping track, where Trump blamed the Fed for inflating the stock market and said he would fire the Fed chair, Janet Yellen. For more, let's bring in Peter Schiff of Euro Pacific Capital. Peter, thanks so much for joining us. I guess, first of all, what's your take on what Trump had to say to the Wall Street Journal about the dollar?
Well, I believe he's correct. The dollar is overvalued, but he's wrong in his view about how the overvalued dollar impacts the U.S. economy, at least, in the short run. And because the dollar is overvalued, we have an artificially high standard of living. And I think that when the dollar does decline, it's going to take the U.S. standard of living down with it.
But then he said that the dollar being strong is really just better for optics. It really actually can be harmful when the dollar is too strong. What do you make of those comments?
Well, I think over the long run, having an artificially high dollar that encourages excess consumption and discourages capital investment and undermines the long-term competitiveness of our businesses is true. We want a dollar to be valued based on the fundamentals. And the fundamentals for the U.S. are lousy. The dollar should be a lot lower. But because it's the reserve currency and because a lot of speculators buy the dollar is higher than it should be. And so Americans get to enjoy a standard of living, at least temporarily, that's out of whack with their actual productivity. And so, this is another example of be careful what you wish for, because when the dollar goes down, our problems are going to exacerbate. And, Donald Trump thinks that a weaker dollar is the key to turning around our trade deficit. It's not. Look at how weak the dollar was under George Bush. The dollar had a tremendous decline under George Bush from 2001 to 2008, yet the highest trade deficits during the Bush presidency were in 2007, 2008, when the dollar was at its lowest level. And by the way, these trade deficits, in the long run, they're terrible for us because we're spending ourselves into bankruptcy because we're borrowing to consume. But in the short run, we benefit because we get to enjoy greater consumption than our productivity would allow. It's our foreign trading partners that are subsidizing this. So, Trump doesn't really understand this. And by the way, his comments on Janet Yellen, it seems like neither Obamacare nor Janet Yellen are going to be replaced. And now that we're dropping bombs in the Middle East, to me, it looks like business as usual there in the swamp. And all the people who were buying into U.S. stocks because they thought something was going to change and that Trump was going to make America great again, better take a look at what's actually happening and separate that from the campaign rhetoric.
Yeah, and that's really interesting. And I just want to make sure, in case our viewers and listeners hadn't had a chance to read that article, that when asked if Janet Yellen was toast, Trump said, no, she's not toast, suggesting maybe actually he likes some of her low interest rate policy. I mean, do you, Peter, want to see Janet Yellen and her policies continue? What are you hoping for out of Yellen and the Fed?
Well, as an American, I'd like to see her replaced because she's a disaster for the country. She's completely incompetent. But Donald Trump is a low interest rate guy. I mean, he said that when he campaigned. And, he wants Janet Yellen to stay, I think, as Fed chairman. And he wants to dangle this carrot in front of her that, hey, you could stay on if you play ball. And what play ball means is, back away from these rate hikes. And, by the way, when the month of February began, the Atlanta Fed was looking for 3.4% GDP growth in the first quarter. Now they're just looking for 0.6. We actually might get negative GDP growth in the first quarter. Yet despite this, the Fed is still posturing as if they're going to raise interest rates. And I think Donald Trump would like to change that posturing to try to blow some air back into this bubble, which now he has basically named for himself, because when he was a candidate, he was very critical of the big, fat, ugly bubble. But now that he owns the bubble, he wants to make sure it doesn't pop. And so he wants to get Janet Yellen to play ball. But as an investor, right, what Janet Yellen has done and what she is going to do is going to make me a lot of money. And it's going to make people who have been following my advice a lot of money. I mean, it's already started. Look at the price of gold this year. It's up about 12%. It's up triple what the Dow is. Emerging markets, same story. They're about tripling the gains on the Dow. And this is just the very beginning, because as the air comes out of this bubble and as all the damage that 8 years of 0% or practically 0% interest rates have done to this economy. When Janet Yellen goes back to the drawing board on QE4, right, when she lowers rates and launches an even bigger quantitative easing program than the last three combined, right, the bottom's going to drop out of the dollar, gold's going to take off, and then people are finally going to see the real damage that has been done to this economy with this reckless monetary policy and the damage that was done under Barack Obama. I mean, he did tremendous damage to this economy, but the Federal Reserve covered up a lot of the effects by inflating these massive bubbles. But it didn't fool average Americans. That's why Donald Trump was elected president in the first place. But unfortunately, he's going to have to deal with this mess.
Well, I think that there's a lot of things here that we can chew on and talk about. So, Jeff, I want to make sure you have a chance to jump on in here and talk to Peter.
Yeah, Peter, thanks for being here. I don't disagree that there's been some damage done to the quantitative easing program. But as we see QE in the rearview mirror, as the Fed is now talking about shrinking their $4.6 trillion balance sheet, and they're talking about 2 more interest rate hikes, walk me through the thesis on how the dollar gets debased and what's that cost, because the Fed has stalemated the dollar at 100.
Yeah, well, the Fed has been talking about shrinking their balance sheet since it started to expand. Bernanke was talking about shrinking the balance sheet. Talking about it and are two different things, because there's no way that they can actually let the balance sheet shrink. Yeah, well, there's no way they can let the balance sheet shrink, because who is going to buy all those extra bonds? How is the Treasury going to sell enough bonds to repay the Federal Reserve? It's just, the whole economy is built on this bubble, and if the Fed tries to shrink its balance sheet, interest rates have to move up dramatically, especially long-term interest rates, and that collapses the stock market, the bond market, the real estate market, takes the banking system along with it. I don't think the Fed is going to shrink its balance sheet. I think its balance sheet is going to balloon to new highs. I mean, they keep talking about how they're data dependent. Look at the data. This economy is a disaster. Look at the retail sector. Retailers are in worse shape now than they were in 2008. Look at the closings of stores. Look at the bankruptcies. Wait again. Look at the retail sales we're going to get tomorrow. But the economy is a mess. I think we've been in recession the entire recovery. I still don't buy these inflation numbers. But even if you look at the government's own numbers, we're just teetering on the brink of recession. In fact, we may already be there. We'll see what we end up getting for Q1, Q2. So ultimately, the Fed is going to change direction. It's going to change its rhetoric. Remember, they did not see the 2008 financial crisis coming in mid-2008. They had no recession in their forecast at all in the summer of 2008, right before everything blew up and we had the worst recession since the Great Depression. So they have a horrible track record of making economic predictions, and I think they're going to live up to their reputation this time, too.
Scott, we got to let you get a chance to get on in there, too.
Well, Peter, my question is that you say we may already be in a recession, but no matter what we get from GDP this quarter, GDP has done pretty well. It certainly isn't saying that we're in a recession. And if you look at the jobs numbers have been pretty good. A little disappointing last month, but both the non-farm payroll numbers and the rate certainly don't say that we're in a recession. In fact, they say absolutely the opposite. And the inflation numbers certainly don't say that we're in a recession. So what in the world makes you think we're in a recession?
Well, first of all, the jobs numbers are not good. I mean, superficially, yes, we create a lot of part-time jobs. We create a lot of, low-wage jobs. A lot of people now have 2 or 3 jobs instead of 1 job. So this is not a strong labor market. Why do you think Donald Trump won the blue-collar vote in the Midwest? These are workers who are suffering under this supposedly great jobs market, and the GDP growth is not good.
That has nothing to do with whether or not we're in a recession. That has nothing to do with us being in a recession.
Well, it is. About inflation? Look at all the other
if nobody has any
evidence.
Money,
but again,
then why are we? If nobody has any money, then why are we experiencing so much inflation? More inflation now than at any time in the last 8 years.
That is the delayed reaction, the delayed effects of the quantitative easing, of the money printing. That's the inflation. Prices don't rise because of economic growth. Economic growth keeps prices from rising because economic growth increases the supply of goods because you produce more. What causes prices to rise is a weak economy, an economy that is not productive and where you have a central bank that is printing a lot of money. So we are going to get a lot of inflation, but we're going to go into a recession. It's called stagflation. And you know what? what? Even Alan Greenspan is forecasting stagflation. And he ought to know because he wrote the playbook that Ben Bernanke and Janet Yellen are following. And so it's not just me. Alan Greenspan says we're going through a protracted period of stagflation. And from an investor's perspective, the worst place you can be in stagflation is U.S. bonds and then U.S. stocks. You want to be in gold. You want to be in gold stocks. You want to be in foreign stocks. You want to be in emerging markets. And you want to be out of the U.S. dollar.
Courtney, here we go. And
Well,
in case you didn't know, hang on one second. Peter's in the business of selling gold, and he finally got around to telling people, trying to scare people into buying gold. That's the
yeah.
all right,
Yeah,
guys.
look.
Go ahead,
Everybody
Peter.
that comes on CNBC is selling something, right? I have a gold company. I have a stock brokerage firm. I have an asset management company.
Peter,
I'm not just in the business of having people buy gold. I buy stocks. I buy all sorts of investments. But I recommend what I think is going to make investors money. And you know what? Gold is outperforming the U.S. stock market this year by triple. Right? And if you go back to 2001, people who bought gold have much more money than people who just bought stocks. So buying gold, having gold
Peter,
as part of your portfolio has been a wise choice for investors. It's too bad you guys haven't figured that
Peter,
out.
that's an interesting question. Since the end of 1989, so since the beginning of 1990, the S&P Total Return Index is up about just over 9% a year. During that period, gold is up less than 4% a year. So
Yeah,
if
you're
you had
picking
bought gold then,
1990.
you would have, let me finish. Let me finish.
Why don't you pick 1970 then? Go back to 1970 and pick it. Gold beats the stock market. Or go back to 2001. You're just cherry picking your numbers.
If you'd bought the S&P, your money would be up 11 times. So you can talk about year to date. You can cherry pick if you want.
No,
but
I'm starting in 2000.
CNBC, you said that everybody who comes on CNBC has something to sell. Peter, 99.99% of every trade I've ever executed has been from my personal account or my firm's proprietary account. I don't wait for people to call me and pick up the phone and give me money to manage. I don't do that.
Yeah,
I
you know
don't
what?
sell anything.
I'd be willing to bet that
fact
I've made a lot more money in my personal account over the years than you've made in your personal account. I trade for myself, too. I eat my own cooking. Right? How much money did you make shorting the subprime market?
Peter,
were you short? I was.
Peter,
how much money did you make when the dot-com bubble burst?
Have you ever been a fan of selling gold? Have you ever been a fan of selling gold?
Now, I started buying gold for my clients in 1999. Let me answer the question. When I started buying gold for my clients in 1999, it was under $300 an ounce. It's now almost $1,300 an ounce. People who have been following my advice have made money. How many people came on CNBC in 1999 and touted dot-com stocks where they went to zero? Yet you don't give those guys a hard time. They blew their clients up. They lost all their money when I was telling people to buy gold below $300 an ounce. And, there's another financial crisis coming. Almost everybody on CNBC was shocked by what happened in 2008. Well, if you just listen to me.
You've been saying that the Fed.
No, I have. I've been right for 10 years.
Yes, you have. And you've said that the Fed can't rate in 2015.
And they can't. Why do you think they're still so low?
They have, Peter. They have.
They barely raised them, and the economy is already back on the edge of recession.
You can't have your own facts. You said in 2015.
Look, no, I don't have my own facts. Look, why don't you pull your head out of your rear end and actually look at what's going on?
Was next, and you've been fundamentally wrong.
It is next.
Fundamentally wrong.
Look, you can make fun of me. You can tell all the jokes you want, but I'm going to be laughing all the way to the bank.
All right, boys, I feel like I have to be the referee and step in here and call it. Everybody has a scorecard. Sometimes you win, sometimes you lose. But we thank you all for joining us. Thank you so much, Peter Schiff, for being with us today on Futures Now.